Hi, everyone, and thank you for joining us today. I'm Jenny Kim, Senior Associate at AVPN. For today's session, we are joined by Dr. Frank Aswani, CEO of AVPA, and Naina Batra, CEO of AVPN. In this session, we will start with a fireside chat with Naina and Frank before we move on to a Q&A with some of the upcoming fellows from the Africa Asia Impact Investing Fellowship. I will now pass it on to Naina to kickstart this conversation.
I'll go. AVPN is the #1 social investment platform in Asia. We bring together more than 650 members who deploy capital ranging from grants all the way to impact investing, ESG, and sustainable investing. AVPN's mission is to move capital towards impact, and we are very confident that with our 650 members, we will actually help the next decade of Asia to be more inclusive and more impactful. Frank?
Yeah, AVPA is a Pan-African network of social investors who are collaborating to increase the flow of capital into impact investing. We bring together deployers of grants, debt, and equity, all interested in achieving social impact across the continent. We have our headquarters in Nairobi and offices in Johannesburg and Lagos. And we support social investors in various ways through research and providing data and information to support their investment decisions and market knowledge. We offer platforms upon which they can connect, engage, and transact, and support each other in co-investing and learning from each other. We also offer knowledge and other types of resources, either generated by AVPA or from the network at large. And we are AVPN's sister network in Africa, so we are also here to connect Africa to Asia and vice versa.
Thank you very much for inviting us to be part of this very exciting conversation, and also to sort of almost as a kickoff for our inaugural Asia Africa Impact Investing Fellowship. I think we're very excited about the potential of seeding impact investing amongst a group of 60 very, very talented individuals who are coming from a diverse set of backgrounds that I think will really add to the discussions, both in the classroom and as they build a community together. I think this kind of cross-continent sharing is going to really lead to a rich dialogue, but also hopefully to unique and interesting collaborations as far as impact investing is concerned.
Yeah, and Naina, this is a really good opportunity for both continents who have a lot more similarities than they have differences. Actually, we look at a lot of the cultural similarities, religious and otherwise. That if Africa and Asia share, I think it will really be a very rich, enriching experience for the attendees to this program. And we believe that the value exchange that will take place and the relationships that we build during the tenure of this program will be phenomenal, and will build strong ties between both regions, but also create some really strong learning opportunities for both networks.
So the first question, I think, is, so Frank, how do you think the conversation around impact investing has evolved over the last 10 or let's say 5 years in Africa? I'd love to see and tell you then about Asia.
So if you look at how impact investing has evolved in Africa, let's start with the problem we're trying to solve. And the problem we're trying to solve has been one of where Africa hasn't made the kind of progress that was expected and required. If you look at Sub-Saharan Africa, we are on course to meet only 2 of our 17 SDGs by 2030, and we are in the last decade of the SDGs. Our annual SDG gap is between $500 billion to $1.2 trillion annually, and this is a continent that was whose social financing was heavily built on aid and government funding and some FDI. But over the last couple of years, and a study that AVPA did demonstrated that aid to Africa is declining. During Trump's tenure, USAID cut its aid budget. Recently, we saw that the UK government also reduced its aid budget from 0.7 to 0.5% of GDP, and that's on a shrinking post-COVID GDP. So the signs are there that the continent has got to look differently at how it funds its social investment needs. And our public debt to GDP is also growing significantly as we try and play catch up on infrastructure and other things. And also the COVID crisis has created an even more pressing financial pressure on the African economies. So when you look at all of these things, we can't use yesterday's solutions for future problems. We've got to be thinking differently. We've got to be asking ourselves, how do we attract more capital? How do we deploy capital better? How do we make sure that the capital we're deploying is having maximum impact and reducing the losses that we've seen in the past coming through some of the aid capital we've attracted? So this is where the role that impact investing is really playing in terms of shaping Africa's future. More and more people have realized also that we don't have enough capital in the social space. So we've got to be thinking how we crowd in private capital into this space. So the conversations and the significance of impact investing have grown in leaps and bounds. We're seeing more players getting involved. We're seeing more people asking themselves, how can they be part of the impact movement on the continent? And that we're very excited about.
No, that's really good to hear. And, I think I see a similar trend in Asia. In fact, I feel that impact investing as a concept and as an approach is growing in sophistication. And, I think, Frank, what's interesting is we have more than 650 members in our network. And when I talk to them, I actually notice several trends, which I think are really interesting. So it's no longer just about impact investing, but they're actually talking in terms of thematic investing. So for example, sustainability, or looking at investing in agri, or otherwise looking at investing with a gender lens. There is a lot more focus on solving complex issues, which I believe requires collaboration with unusual allies. And that's what, we hope that networks like AVPN and AVPA that's what they do. They bring unusual allies together. I also find, and you mentioned this, I think in answer to a question that one of the fellows had asked, but there is an increasing desire to adapt financial instruments for traditional financial instruments for use as vehicles towards impact investing. And, to do that, we are seeing an uptick in blended finance and in blended finance instruments. So it's interesting. We're finding, at least over the last couple of years, I'm seeing that blended finance in Asia is moving very much from policy to practice. And over the past year, I see, especially post-pandemic, there has been a significant increase in coordinated activities with respect to blended finance in an effort to be more effective, to be more targeted, to be more efficient. And a couple of examples, which I think also trend, or transcend geographic boundaries. So one is, the Catalytic Capital Consortium, or C3, which is looking at demonstrating the power of catalytic capital investment capital that is patient, that is risk tolerant, that is concessionary and flexible to extend and deepen the reach of the impact investing field. So actually foundations making this catalytic capital available to investors so that they can go into, otherwise investments that they would not be doing. We've also seen the launch over the past year of the R3 Investment Coalition, which is the Response, Recovery and Resilience Coalition. There is also, post this pandemic, I find a good potential to scale blended finance for health, which is, obviously we are all living through the pandemic even today. And there has been interest in looking at innovative healthcare systems, health tech, all of which have significant impact besides financial returns. And, we are finding, especially Southeast Asia, which is proving to be an emerging area that is, having a great increase in blended finance. And activity has actually grown over the past 3 years with a number of instruments, including social impact bonds, including venture philanthropy funds that have been launched. And finally, I would say that gender lens investing in blended finance has also started getting greater attention. And this is obvious because we have a huge proliferation of resources, toolkits, and initiatives that have been led by various actors across the public, private, and philanthropic sectors. So to me, this is a sign and something that I think Africa should look at and follow of maturing social impact ecosystem here in Asia. And I feel that over the past 5 years, we have suddenly seen a far more increase in impact investing, both in terms of the interest, but also in terms of the actual investment that is being made. So I have another question for you. So what do you think? I mean, I was telling you about the pandemic, but what has it done in your market? I mean, has it led to impact investing becoming more mainstream, or do you still see impact investing as being appealing only to a niche group of investors?
So that's a good question, Naina. And if I look at what the COVID crisis did, the first thing was to really expose the inequalities in society. I think we saw inequalities that we knew there was inequality, we just didn't know it was at that level of scale. As part of the crisis, we ran a series of webinars looking at showcasing solutions to bottom of the pyramid challenges, which I was flabbergasted by the scale of what I saw. This inequality is a lot bigger than we thought. The problems, even when you don't have the precise data, was really blown up by the COVID crisis. The second thing that also came out of the COVID crisis was the level of social innovation in response to the COVID crisis. We saw tremendous innovation within very short period of time to address things like education to kids who didn't have access to the internet, access to food care, to food and to people who lived in slums and the peripheral areas of big cities. Healthcare provision in times when social distancing was mandatory. I was amazed by just how much social innovation came through. They always say, "Don't waste a crisis." How can we are the generation that have been blessed with the crisis. How do we leverage this to make sure that we are building upon the lessons learned from this crisis? And I think as we look at some of these innovators coming through, there's some really good solutions that we need to be asking, what do they need to scale? And this is where impact investors come in. And we've tried as much as possible to get impact investors to connect with some of these innovators and the solutions to see how they can support them to grow at speed and the required speed and scale to address these issues, not just within the cities where the innovation came from, but across multiple countries. And it's been very interesting to see the relative appetite for that. But in all of that, there's still been the issue of a lot of our traditional impact investors being either grant makers or private players, not understanding how to play in this new space that is demanding of us to blend capital, for example. So the competence to play in this innovative financing space has hampered a lot of the ability of people to actually be comfortable in being effective impact players, because they both recognize that neither of the two extreme types of capital are sufficient. We need to see how we blend the two together. So, and that is very evident if I look at just the applications we received, for example, for the Africa-Asia Fellowship Program. It was oversubscribed by 3 times because people suddenly are realizing that, geez, I need to know a bit more about how to play in this new space with these innovative tools. And that is very encouraging in my view. So in short, the COVID crisis has done a lot about elevating the significance of impact investing, but at the same time highlighted not just inequality, but the lack of innovative financing and impact investing competence amongst our social investors.
No, I think 3 things you said that really resonated with me. One is, let's not waste a crisis. And I couldn't agree with you more. I think in Asia, like you have mentioned in Africa, I think what the pandemic did is really expose the big underbelly of unequal societies, of the growing gap between the rich and the poor that exists. And, in Asia, like we saw in many different parts of the world, the very rich actually became even richer. And the poor actually became poorer, if that's even possible. But I would say even the lower middle class got pushed into poverty. And I think that's something that governments across Asia are struggling to see how they can reverse that and how can they help in poverty alleviation. But having said that, I think there were certain sectors that really did well. And, we cannot reverse, for instance, the use and adaptation of technology. And I think there was a lot of impetus given to impact investing because of this, really sort of adaptation of technology in rapid time. And I think even though we see different industries coming back and growing, I don't think we will reverse this technological advance that has happened as a result of COVID. And what we found actually for us here is that a lot of VCs suddenly started taking interest in sectors like edtech, in sectors like health tech, and of course in fintech, which has always been very appealing to more mainstream investors because it's the least risky of all kinds of impact investing. So again, a couple of examples of our members. So Chirate Ventures launched the Chirate Thrive Fund, which actually looked at giving economic relief to low-income gig workers associated with their portfolio companies. But they were telling us that their portfolio actually did so much better through the pandemic. We also found actually, not just Chirate, but we found even other members like Leapfrog and others who actually used the pandemic to look at supporting their investee companies, supporting the employees of their investee companies. So I think, they looked at impact in the true sense, not just from a financial perspective. But, talking about technology, we found that it was interesting. Open Space Ventures, for example, is a VC that's focused on early stage tech companies in Southeast Asia. And it looked at embedding impact and ESG in its portfolio. Now, Open Space's existing portfolio companies include Gojek, Halodoc, Topica, and Bioformis. They're already considered to be impact companies in their own right because they're solving vital problems in their respective geographies and improving the lives of many, especially through the pandemic, when regular employment was really not possible. We're also finding that technology has helped the underbanked or the unbanked in Southeast Asia to actually have access to financial services. And we think this is a trend that cannot go back. And we're finding more and more VCs, more and more impact funds that are investing in this kind of technology. So I think it's very, very interesting. And what the final thing that I thought, which we saw, which was also worthy noting, is that impact investors are reprioritizing and managing their risks differently as a result of the COVID-19 pandemic. And, for example, Circulate Capital, it's an investment management firm, and its founder, Rob Kaplan, said that this is the most opportune time for impact investing. In fact, their Circulate Capital Ocean Fund, or CCOF, which is the world's first investment fund dedicated to the ocean plastic crisis in Asia. It made its first two investments in plastic recycling companies located in India and Indonesia to a tune of $6 million during the pandemic. So I think a lot of our members actually said they saw investment in some of these kinds of sectors go up as a result of the pandemic. The other thing which I thought was interesting is that, you mentioned health, of course. These are, key areas that we saw that investors are favoring. Public health, as I talked about, because obviously we are going through a healthcare crisis, technology, and clean energy. And I thought all of that was interesting, especially clean energy, and I hope it will continue. And I'd love to hear from you, what are the areas you're seeing in Africa that are of interest? Because climate change, I think this whole crisis, if not anything else, has brought home to us that, climate change is a very urgent issue that we need to address, especially in the economies of both our continents. We have growing economies. They are the ones that are under a lot of pressure from the more developed economies, and the argument can be made that the developed economies actually polluted the world, and we are now being expected to carry the weight of, development along with, developing in a clean, sustainable, and renewable way. So I'd love to, ask you, what are the kinds of trends? Is it the same as us? Clean energy, health, and technology that are exciting sectors for African investors?
Yeah, it's interesting, actually. I'm smiling as you're talking because if I look at the similarities, mobile money, for example, in Africa is a very big space. It's done a lot in terms of financial inclusion through products like M-Pesa. And it was amazing just how much the mobile money platforms and technology was used to address like food insecurity issues. So we hosted a couple of communities of response in Kenya, Nigeria, and South Africa, and brought together maybe something like 500 organizations across the 3 platforms, and a lot of collaboration initiatives sprang from that. But one very interesting one came from the South Africa community, where it's called the Mtunzi Network. And in 3 months, you'll not believe this, an organization was formed from people who had not met before, including the South African Council of Churches, and their job was to realize that, okay, we can't get food parcels to people in the bottom of the pyramid. So can we create a company that can do digital food vouchers? And in 3 months, these guys was setting up in the range of 250,000 digital food vouchers across South Africa. And this is just because you can leverage technology and you can move fast and nimble. It was amazing to see that. But we saw a lot of initiatives in multiple countries, in Kenya, Nigeria, Zambia, and elsewhere, where technology was the foundation upon which response was built upon. But I agree with you, the healthcare space benefited hugely from this crisis, and we've seen a lot of businesses spring out. And what we need to make sure is that we don't lose the gains that we've created. We don't lose the momentum and the innovative spirit that COVID has brought upon us. And that's why, let's not waste this crisis. But healthcare technology were very important. Supporting of food security was another thing that we've seen in Africa. A lot of support has gone to smallholder farmers. We're seeing a lot more initiatives go around urban farming to make sure that people can actually just farm for themselves and grow their own food, those kind of things. And the last sector that got a lot of attention, just because once again it sprang from just the stark inequality that we face, was education and access to education, and how this really exposed the disadvantage that poor kids have when it came to access to education. Because as soon as schools went online, the kids living in the most urban areas could go online and access class. The ones who are not could not. But it was interesting to see how people who are now using WhatsApp to push content and lessons around. People found partnerships with telco companies. So I'm really excited by just the level of unusual collaboration and partners that COVID brought together around the table to find a solution to some of these issues. And we have to make sure that we don't lose that momentum as we seek additional problems additional solutions to problems that we're facing going forward.
Oh, absolutely. And as you said, there are so many more similarities than there are differences. I mean, I think it's interesting. I think one of the biggest things that the education program, especially schools going online, did was really expose inequalities. And it really didn't matter if you were from a poor country or from a rich country like Singapore. We still saw so much inequality in how children can access education. And not only that, it was also interesting, and this is where I think investors have to take a very sort of forward-thinking, very progressive approach, because it's not just about replacing the classroom through a Zoom screen or a video screen. It's about rethinking that entire pedagogy as to how it's going to be developed and how is it going to be delivered. Because, children who go to school learn from each other. There's a whole social aspect to it. And I think that's what we are hoping to see going forward, where, you're listening to people on the ground, you're listening to organizations on the ground as you're coming up with these solutions. And it's not just sort of using technology for the sake of using technology. I think it's we talked about collaboration with unusual allies. I think what your network and mine really stand for is really bringing people together, is really looking at how do we encourage different forms of capital to come together and collaborate. And I'm hoping, along with you, that this fellowship is the start of building a cross-border, cross-thematic, cross-capital community that will really look at addressing some of the most complex challenges, using capital, using financial instruments, financial structures to really look at driving positive impact on a more sustainable and long-term way. So very excited about the partnership and looking forward to many more from this. Thanks, Frank.
Indeed.
Thank you.
Indeed.
My name is Faithful Taruwinga. I'm the Group Chief Finance Officer for Delta Philanthropies and Higherlife Foundation. These are two foundations that were founded by Strive Masiwa and Mrs. Titi Masiwa. We do impact work in Zimbabwe, Lesotho, and Burundi. Then my question is, what are some of the hurdles that impact investors encounter when they partner with conventional investors? So I'm talking about returns, where an impact investor is looking for social returns, whilst a conventional investor is actually looking to maximize commercial returns. How do we bridge that gap?
Happy to go first. Faithful, it's very, very nice to meet you, Faithful, and thank you for joining the program. I think you hit the nail on the head, because conventional investors are looking at financial returns and only financial returns, and impact investors are looking at hopefully a mixture of both impact and financial returns. And what usually happens is that when the investor is focused only on financial returns, they sort of push the entrepreneur or push the organization to look at maximizing financial returns, even if that means moving away from the impact objective. And oftentimes what we have found is when you have impact entrepreneurs who are keen on, sort of having impact front and center in the business model, when they have conventional investors who come in, they are often pushed to move away from this objective. It is seen sometimes also, and it could be a wrong perception, that conventional investors equate impact investing with discounted returns, and therefore are even more sort of focused on the financial viability, the financial sustainability of the business model. So sort of coming into the discussion with two varying objectives, I think, is a problem. And the second issue sometimes happens is when you're looking at different metrics for success. So because impact investing's metrics are not as universally recognized, and we don't have uniform set of metrics like the accounting metrics that look at financial returns, that's another reason when there is conflict between what an impact investor may look for versus what a conventional investor may look for. Frank, you want to add anything?
Yes, Naina. I think building on what you've said, and faithful to your question about returns especially, it's also how the view of the risk of the business is looked at by both investors, and what can we do to de-risk some of these social investments so they can become a bit more appealing and attractive to private capital, which we know we need the private and conventional investors to put a lot more money into this space. So this is where, as you asked about how do you overcome some of these barriers, this is where some of these innovative financing approaches come into play, where we blend finance, leveraging grant capital to de-risk social investments and improve the risk return profile of some of those investments, and crowd in private capital in the process. So there's some really innovative approaches, and part of the benefit of this fellowship program is to bring forth and educate the general investment community, of which you're part of, Faithful, on what are some of the options you have to bring closer the expectations of risk return expectations of both type of investors. So the course will give you a number of tools upon which you can build in answering some of those questions. Now, the other thing that also creates a problem is when you're looking at deals that are just not conducive to either of you. One person is looking at a deal that's very impact heavy, another one is looking at has more financial return opportunities. And what AVPN and AVPA try to do is to try and bring some of those deals that kind of bridge that gap together. So some of the tools that you learn about through the program that are available through both networks like our deal share platforms offer you some really good opportunities where some of these expectations are much more closely matched compared to just going out and finding deals that may not meet the expectations of both types of investors.
So the question is directed to Frank. So how have impact investors in Africa instituted sustainable investment principles and actualized the sustainable development goals? And then maybe Naina, you can take this from the Asia perspective as well.
Yeah, Jenny, that's a good question, Oladele. we recognize that the impact investing space in Africa is still nascent, it's still growing. Standardization of some of these principles are still taking root, but the spirit of embracing sustainability is definitely growing. There's no question about that. We're seeing a lot more people asking themselves the tough questions about what is the impact of my investing having on the environment, on women, on kids. Those questions are coming up repeatedly amongst many impact investors. As we try and find standardization of a lot of these principles, what I tell people, at least pick one, then not have none at all. And as a system and ecosystem evolves to align on what is best to follow, and we'll be playing a key role in trying to see how we can support that particular direction. We're at least finding people sticking to the SDGs as a framework upon which they want to measure their progress and impact in this space. So more and more impact investors are showcasing and reporting back on their performance against SDGs, even if it's at a very high level. We're seeing a lot of financial institutions, whether they're banks, in their annual reports now, it's very common to find SDGs as part of their reporting back and metrics upon which they report their performance, not just financial metrics. So it's growing, but we're not yet there. That's work we have to do, and part of what we are hoping to do through the engagement with the ecosystem and the fellows in the program is to start addressing how we can make this a lot more mainstream and make sure that transactions in Africa have an impact lens at all times, because in many ways they do have a societal benefit or in one form or another, but can we be a bit more deliberate in how we aim to achieve some of these things and not just do it by chance? That's some of the stuff we've got to do. So in short, this work in progress, but the momentum is definitely there. Naina?
And I think, Asia may be a little bit more advanced at this point in terms of both the size and scale of impact investing. But I think the SDGs provide a really urgent metric that a lot of impact investors are now using. And it's not just impact investors and financial institutions, as you said. I think a lot of corporates are also now looking at measuring themselves against the SDGs and what they have achieved. I think there is a sense of urgency, especially post-pandemic, when progress against the SDGs, which was slow to begin with, has really been reversed in a lot of cases. So I think there is a lot of pressure from different types of stakeholders, whether they be customers, whether they be investors, whether they be employees, that organizations look at themselves not just through a profit lens, but also through a purpose lens. And we are finding that there is a great more sort of appetite to be looking at the SDG framework and looking at their performance against the SDG framework.
Hi, Naina, and hi, Frank. Jonathan Chang here from Singapore. I'm the head of growth for governments and organizations at Shopify. And my background is a mix of academia, entrepreneurship, impact, and public policy. My question is, how does corporate venture philanthropy fit within the impact investing strategy? Thank you.
Thanks, Jonathan. And you're the right person to be asking this question. It's great to see you again. So I think there's a very strong link with corporate social impact or corporate venturing and impact investing. What we have seen especially is that a lot of times many corporates, in fact, are extremely sort of hemmed in by their risk appetite, by what they are able to actually do as far as impact is concerned, as far as investing in impact entities are concerned. But through their kind of corporate social venturing arm, they are able to incubate impact enterprises and then therefore look at sort of broadening their portfolio using their corporate impact venturing versus directly making an investment as a corporate entity. And I'll give you a couple of examples. So we see, whether it's, if we look at, there's an AVPN member, MISC, which is an intermediary and an incubator in Korea. And one of the things MISC has done with a number of Korean corporates is actually help incubate, as part of their corporate social venturing, actually helped incubate enterprises that are far more impact focused than the actual corporate, and have then looked at a potential whereby, after testing the proof of concept, after testing and making sure that that fledgling impact enterprise is poised for growth, the corporate has then been able to incorporate that as part of its own investment portfolio. That's one example. We also see corporates like IKEA or Schneider Electric that have used corporate impact venturing as a way to foray into impact investing. So whether it be looking at making impact investing into their suppliers, whether it be looking at helping incubate impact enterprises through their sort of supply chain, both have been ways for them to kind of use their corporate social impact arm as a way to get into impact investing.
Snider, I'm Mugese here from Villgro, Africa. I have two questions for you, and the first one is, what is your theory of impact as AVPA? And the second question would be, how does AVPA integrate into the fundraising of very early stage startups, given that they require a lot of de-risking?
So I think Frank alluded to it when he was answering a question for Faithful as well, in the sense of using a blended form of capital. So with impact investing, and especially as AVPN has talked about on a number of occasions, right, we look at what we call a continuum of capital when we are looking at making these investments. So grant capital is usually capital that can be used for first loss, that can be used as initial risk, capital that has a huge appetite for risk, and blending that in with capital which is looking for more market-based returns is a way to kind of manage that risk appetite, especially for early stage. What we have also found more, I think, more and more over the last couple of years is a lot of foundations have started to incorporate impact investing as part of their grant making portfolio. And they are very happy to take the first level of risk in an impact investment. And we find this in many structures, especially in Asia. And I'm going to ask Frank to tell us about what he sees in Africa. But in Asia, we see that even with institutional funders, we find that DFIs take the first level of risk, and then have more commercial-minded investors coming in, either at the mezzanine phase or at the next higher phase, sort of lower risk but higher return phase. So it's a question of how it's blended, and that's where I think impact investing has an edge, where it can, especially if the focus is on impact, where it can call on different types of capital in order to modulate the amount of risk that the final investor takes. Frank, you want to add anything?
Yeah, I think also it depends on the kind of investor. Are they local? Are they international? You find your international investors who are bringing Forex will be thinking about currency risk. How do they cushion and mitigate that? You'll find part of it is also the lack of local know-how. Important for us to build a strong base of local investors who can co-invest alongside some of the foreign investors coming into our regions. And that way you get a local partner who's got local know-how, who can help you mitigate some of the issues locally as a major part of your financial investment making decision. So there's multiple ways I think risk can be mitigated, but very importantly is don't underestimate the knowledge that the entrepreneur and your co-investing partner knows about the local environment. And that is something we're highly encouraging a lot more international investors as more money comes into Africa to do deliberately in their choices as they make.
Great, thanks everyone. My name's Julia and I'm based in Johannesburg here in South Africa. And I'm one of the co-founders of Linea Capital, which is through a partnership with USAID promoting revenue-based finance as an impact investment tool for growing businesses. I've also got a special interest in funding female founders. And so I'm involved in a few VC funds here on the continent. So my question to Naina and Frank is, in terms of the longevity of the impact investing industry, both here and in Asia, what do you believe the best strategy is to excite and include the next generation of angel investors or VC investors in impact investing? And then I'd love also your take on including female fund managers in impact investing as well. Thank you.
Okay, Naina, can I go first on this one? So Julia, first of all, nice to meet you, Julia. It's really nice to have you join the program, and once again to put a face to the name. In terms of strategy, I think there's some key questions we have to look at addressing as we look at how to attract more capital into this place, into this space, and especially get more players in the impact investing space. But for starters, I think as we think about attracting more players is to first of all make sure people understand why this is important to do. Why is impact investing important to do? Africa is going into a really critical phase at the moment. We're in the last 10 years of our SDGs, and we are going to struggle to attract the right amount of capital to meet our social investment needs. And there's a really critical role for early stage VCs and angel investors to support some of that early stage investment, especially in building SMEs, which in turn not only provide services, but also create a lot of jobs. It brings me to my second point is one of the things that this ecosystem is still struggling is how do we effectively deploy small ticket sizes to businesses, SMEs, because our African SMEs are still not able to absorb the large amounts of money that come from DFIs and some of the bigger investors. So how do we figure out an efficient and cost-effective way of getting small ticket size investments to small businesses, and then handhold them in a manner that they're able to not just attract but access follow-on capital from bigger investors downstream. The other thing I think we need to think about is it's not always about money. In the process of trying to understand how we've carried forth this space is making sure that as we align opportunities to capital, but also not forget that there is a lot of non-financial support required for these businesses. And as they get bigger and bolder, they need a lot of support on a governance perspective, strategy, whether it's IT systems. There's a lot of other things that they need to be pulling along with them. How to measure impact, M&E, all those kind of things are critically important when you look at how supporting small businesses. So I think it's very important that we look at some of these factors as we think of building a strong ecosystem of investors in the impact space. Nina?
Thanks, Frank. Hi, Julia. Two questions you had. The first one was how do we attract more of the next gen? And that's really important to us here in Asia, partly because, there is the biggest transfer of wealth that is taking place in Asia over the next few years from the older generation to the next generation. There is a lot of interest in impact investing, but I think there is a need to sort of de-risk the idea that impact investing is risky, it's associated with discounted returns, and Frank was talking about in the continent associated with very small ticket sizes. I think there are three things that needs to change. One is the scale of impact investing needs to increase in order to attract VC investors, in order to attract family offices to deploy their whole portfolio and not just a small sliver of it to impact investing. And that can only happen if we have sustained capacity building. We encourage entrepreneurs and management to stick to the impact proposition in their business model as they're going ahead. And thirdly, and most importantly, we have a uniform metric of measuring impact. I feel the biggest argument and the biggest sort of disadvantage impact investing right now has is that there isn't a uniform metric. There are some who use IRIS Plus, there are others who use the IMP principles, there are still others who use the principles put out by IFC, and that's really not helpful for the sector. In terms of looking at women entrepreneurs, and I think that's in general an issue. Having access to finance for women entrepreneurs has not been easy. It's not easy for any entrepreneur, but it seems that women entrepreneurs find it even harder. And I think having programs, some of which the USAID has also supported in the Asian region, have been helpful in looking at how we can encourage more women entrepreneurs to look at scaling, looking at growing their business. Once again, I think capacity building and TA is a very big part. The impact funds that we have found that have done well have, in addition to the financial investment, actually supported the entrepreneurs through TA, through providing a shared suite of services, whether that be related to HR, whether that be related to strategy or technology. And all of that has helped significantly in the case of women entrepreneurs. So I think if we can look at a sustained piece of the investment going towards TA, going towards strategic capacity building, and looking at the three things that I mentioned, which is impact metrics, looking at larger scale impact investing, and larger scale organizations that are focused on impact investing, and then of course advocacy and education for family office advisors. I think that will be something that we will see a very positive uptake on impact investing.